about 6.5 hours after the market close, and this is my first chance taking a look at the markets. But if you'll recall, earlier this morning I wasn't able to create the video, so once again I sent out notes. We noted that futures were essentially flat. There wasn't really any bias that we could draw from the futures markets, and we wanted to watch carefully for directional movement throughout the morning. Our feeling was that we might trade in a range today, so not a lot of directional bias up or down, just kind of chopping sideways. At least that's what we were feeling based on just the futures markets. Oil futures were up. There was a mild upward bias. VIX was opening down. Bond futures were also down. So with limited implied volatility, that meant that the range within the day was probably going to be more muted. So that just added to the feeling that we might be trading sideways today without real range or real bias going up or down. There is a huge range of different types of companies who were reporting their earnings today. We had industrials like 3M, staples like Johnson & Johnson, which is sort of healthcare as well and sort of staples as well. We had AMD, Microsoft, so we had tech, we had American Express, a couple other financials, Raytheon, Lockheed Martin, so defense sectors, Starbucks, consumer discretionary. So we had a whole mixed bag of earnings coming out today. How that went would dictate today and tomorrow how the market is going to go. So the major dominant force in the market right now continues to be earnings. If the markets are flat and they continue to be flat, it might be better just to wait it out and see what happens. So let's see what actually did happen. Did the market actually chop sideways as we felt like was the stronger probability? And looks like we got a little bit of directional upward movement actually. So positive movement in the S&P 500 right into that EMA 8, which is our first spot of resistance. We don't expect this to be a strong area of resistance. That MA 200 to EMA 20 really is where we're looking to have stronger resistance, but that MA 200 is an important psychological point for institutional traders because there's a lot of mandates around what institutional traders can and cannot do around the MA 200. So that's going to be a very important part. Tomorrow, if we continue to move upwards, there's a pretty good chance that we'll pause at that MA 200. And then if we continue to move upward after that, and then perhaps we'll pause at that EMA 20 and finally hit that EMA 20 mark. That'll coincide with basically the end of the week. So we'll have to wait and see whether or not we can get above that EMA 20 after the weekend. But so far, this is a nice, beautiful bounce off of this blue line that we're talking about, and we basically perfectly touched it and went up. That doesn't always happen. Again, these are always ranges, not a specific line. So we always have to remember that this is a zone and it's not a perfect line right here. But in this case, it bounced off of it perfectly. Right now, we're at the EMA 8, first area of resistance. If this market becomes super weak, then yeah, we could come down from here. But really, we're going to expect that it can at least get to that MA 200 and most likely to that EMA 20 as well. Let's take a look at what happened in QQQ. QQQ bounced up, nearing that EMA 8, also nearing that horizontal resistance. We have less optimism about the QQQ, so that tells us we should probably focus a little bit more on defensive sectors. So focus a little bit more on staples, focus a little bit more on utilities, maybe some healthcare, maybe some energies. Let's take a look at what happened at energies. Energies bouncing off of that MA 200. Remember, we expect energies to continue to be strong as long as there is conflict and war in the world. So a breakdown below the MA 200 would be pretty surprising, although we can never say that it's going to be impossible, but it would be pretty surprising. So right now, especially now that we're developing this horizontal support right here, and it's coinciding with the MA 200 and the MA 150, we are really going to expect this to hold. A lot more likely that it's going to hold than not. So as I was saying earlier, utilities, staples, energies, healthcare, these are sectors that we're going to start to focus on. Let's take a look at what happened to DIA. moved up also, up a little bit above the EMA 8, so looking pretty good right here. That gives us better confidence that we can hit that EMA 20 and the MA 200. So again, more defensive type sectors, except these are industrials and staple are materials, and those are not quite the super defensive sectors. So again, we want to focus a little bit more on the more highly defensive sectors, XLU, XLP, XLV, and in this case, not a defensive sector, but energies as well. Let's take a quick look. Normally we see financials and energies highly related. So we did get a bounce off of the financials as well above the EMA 8, actually looking very much like the Dow Jones. Let's take a look at our small cap stocks. Small caps, finally a little bit of relief. Looks like it's starting to consolidate, touching that EMA 8. We'll see how long this lasts. My feeling is probably that this doesn't really look like a bounce. It looks like a move down and then consolidation. So we may chop a little bit, we may move up a little bit, but for the most part, chop. We're not expecting, again, growth in tech to be really strong. So it would be surprising if this one does break above the EMA 20. It's more than likely we'll chop a while money moves over to the defensive sectors, and then perhaps at that point in time, the growth stocks, the more speculative stocks, will start to fall again. Maybe. We'll see. This looks like a new low, actually. Yesterday or 2 days ago, looks like we have a pretty long time low over here. The last time we were that low was last October, so a year ago. So this is pretty significant that we matched, or we may have made a 52-week low right here. If we're pulling back a little, it may just simply mean we're just getting a little bit of relief before we start to move downwards. So we're getting some mixed signals, but the strongest signal that we're getting is that everything is moving more defensive, and we want to be careful and be cautious. We're going to be optimistic that the markets can bounce a little bit from here, but overall, we're not convinced that the direction of the markets has changed quite yet. So if we look at SPY since July, we've been trending downwards, and that downwards trending movement won't change until we get above this MA 50 and above these highs right here. So for now, all we're saying is we're moving higher. We might hit that EMA 20, we might get higher to that MA 150 and MA 50 level, but as far as we can tell right now, that's about it until we can see growth stocks, QQQ break above that MA 200, the IWM moving back up and then breaking above its MA 200 as well, which is quite a distance away. We're not really going to expect that this market is going to get strong and start trending upwards. Let's take a look at our bonds. Let's see what happens in the bonds. Bonds consolidating, so giving some relief. As long as it consolidates and doesn't move downwards again, then everything will be fine. However, we have the FOMC decision, I believe, tomorrow, yes, in just 15 hours. But really, we're just expecting them to do nothing. And that's pretty much priced in. So once we know that for certainty, then the TLT can start to move again, and we'll see what direction it picks. Most likely, it'll pick down. It may not happen immediately tomorrow or the day after, but later in the week or next week, we could start to see movement. And since we've been downtrending, the more likely case is that we will continue to downtrend. If that happens, that's more pressure on stocks. We may have another wave down in the S&P 500. And again, as long as we stay within the consolidation territory over here, which would be 10 to 20%. Right now, the lowest we've seen is about 10.3 or 10.5%. And on average, we would expect about down 15%. So that would take us to these previous lows back here. So we could have another movement downwards. So we'll see when we move up closer to that EMA 20, if we get a hard rejection and move downwards, or we can break this downward trend, the current downward trend right here. Right now, it's a little too early to say, although based on what we see so far, it's not too optimistic that we're going to break this downward trend just quite yet. All right, and let's take a look at our VIX. Let's take a look at our VIX. Our VIX is down quite a bit. And we closed. Why can't I see where we closed? That's interesting. Where did my quotes go? Let me reload this and go to our VIX. And we close at 18.13. We were thinking 17, 18 region would be the first stop. So we've pretty much hit that right now. And if we can get down to the 13, 14, 15 area, that will be very positive for the markets. And so we would move upwards. Right now, not quite sure we'll get there. We might get to 16, 17. We'll see. So if you're in that VIX trade that we did earlier, then looks like we might be nearing the end of that. So it might be a good time to take profits. Let's take a look at what sectors caught a bid today. Where's money moving? All right, so our sectors, if we look just for today, real estate and home builders, that's really interesting. So without any real movement in treasuries or in interest rates and not really having a change in interest rates, so this is maybe just speculation that the Fed is not going to move interest rates and a little bit of money moving in there. And then we've got financials, we mentioned that a little bit earlier, and utilities. So utilities continuing to be strong today, and we've got IWM, retail, and consumer discretionary. That's really interesting. So that is risk on, at least for today, and risk moving away from defensive sectors, moving away from energy, moving away from gold, moving away from bonds, moving away from silver. That's just today. So if we look on a 1 week basis, utilities and gold are still up there, but today was strong enough in real estate and home builders that we see them at the top on a 1 week basis as well. And if we go to the 2 week basis, we can see that really we're more leaning towards the defensive side. So we've got gold still way up here, utilities, staples, silver, all the more defensive sectors at the top. So we are looking at much shorter terms at this period in time because we are mostly ruled by volatility, a little bit less by technicals. But for now, the 2 week time period is showing us that there is still a defensive element to the market. So we're going to be wary. We're going to, again, be optimistic that we can maybe get up to that EMA 20. But beyond that, we really have to wait and see what happens. So let's take a look. Let's take a look at how our trades have been doing so far, our mock trades. Okay, so we have the aftermarket VIX up 22%. That's excellent. I said that we are nearing a target, so maybe we could go one more day, but really we should be pretty happy with the performance so far. We can either take risk off, so partial risk. If we had bought in multiple contracts, then we could close a portion, half of them, 80% of them, let our remaining position ride, or we would just simply take the profit right now. There are also other ways to hedge and lock in profits, but that's a little bit too involved and a little too complicated for me to go over in the aftermarket sessions. So for now, we're just going to take profits here. We're going to be a little bit more conservative, especially now. Right now, I'm traveling. I can't watch things as carefully. So even though these are not real trades, these are suggested just for education and for trading on paper so you can get used to it. We're going to play it the way we would in real life, which is, hey, we've got extenuating circumstances. We can't watch things quite as closely. Let's just go ahead and be more conservative in our movement. We've got good profit. Let's just go ahead and take it. Okay, and we've got gold. We had a gold bull call spread down a tiny bit, but you can see as long as we stay above that 179, we'll get our expected gain, and we are far from 179. We're over here at 184 something. So this spread is still looking very, very good. We have about 2 weeks left in it. So we'll keep that open. Now, we were talking about being more conservative, moving into more defensive sectors, XLU, XLP, XLE, XLV. Let's take a quick look at all of these and see which ones we like the most. So let's take a look at, oops, not B, XLV. Okay, recovering, bouncing, but still, that is a sharp drop, and we're not even at our moving averages. If we want to be speculative, we could move upwards, but really not. As a more conservative approach, I wouldn't be choosing this right now. Let's look at XLU. XLU is looking better, but it is consolidating. It's moving sideways. So maybe an income type trade, an income vertical right here, maybe a good idea. I would be comfortable doing that. XLP. XLP consolidating without that same bounce in XLU, so not quite as strong, but we could do an income vertical in XLP. And let's look at XLE. XLE hitting that MA200, finding some basis there. I'd be comfortable being a little bit more speculative about XLE, and given the entire world situation, really on a longer term basis, XLE should really catch a bid, should stay high and stay strong. So XLE is a pretty good sector for us to move into. Rather than trying to find a specific company in it, today I'm just going to go directly with the ETF, and let's just take a look at what we might do. So if we look at XLE, this is a bull call spread. So let's build a long call in XLE. We'll take a longer term approach, a longer term viewpoint. And so if we do that, we can go at the money, and we can go maybe a 60 to 90 day time frame. So if I go to December 15th, 45 days, January 19th, 80 days. So January 19th is looking pretty good. My wife's birthday, by the way. So we'll go in and take a look at this 85 strike call, and just take a quick look, make sure this is correct. We're buying the 85 strike call for $4.15. That would make our break even $89.15. Do we think we could get above $89.15 by January 19th? And let's see. So let's go ahead and mark these. If I go out to January 19th, and then let's mark 89.15. Okay, could we recover up to these levels right here, which is be the very, 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 very lower band? This would be a weak resistance right here. Stronger resistance would be up here. Could we get up there in all this time? Absolutely. We could get there in 1 or 2 weeks actually, and then move upwards. Can we break above that, above these highs? Maybe. We're fairly optimistic, but at the very least we can get above this purple line, and we could get to these new highs, because this is just a weak resistance right here. It is a horizontal resistance, but this is an entire zone. So actually the stronger resistance is the more recent ones and the higher ends of this entire range right here. So we could get above this purple and maybe into about 91 to 93. So I'm comfortable doing this trade, not doing this trade, but using it as an example of a trade of potential, a high probability trade that could make money. So I'm going to go ahead and save this, and we're going to call this the aftermarket, 31st of October 2023, and that will wrap it up for today. So happy Halloween, everyone. If you have kids, if you're out, be safe, be warm, and I will, if I can, I will do a video in the morning, but most likely not. Seems like the more likely track is another note on what to pay attention to. but I will for sure create an aftermarket video tomorrow. Good night, everyone.